Stop scrolling. If you're watching silver right now and thinking this is just normal movement, you're about to get crushed by the same pattern that wipes out people every cycle. Silver didn't just wobble, it got smashed, and it's still shaking. The reason matters more than the price. I wasn't planning this video today, but then I saw how people explained what happened. Like it was a cosmic accident, like math broke, like the universe glitched. If you're here, you deserve the full story, not comforting tales. It's Wednesday, February 4th. Drop a comment telling me what time you're watching because I want to see how far this message travels. Here's what triggered this video. Over the last few days, I've seen posts saying, "This has never happened, the model is broken, 10 sigma day, statistical impossibility, black swan." When you see those words next to a chart that looks like a heart monitor during panic, it's natural to feel sick. But the mistake is what people conclude. They see violence and assume the thesis is dead, volatility equals failure, the move was fake, and it's over. That's how you end up selling at the bottom and buying after the bounce, donating profits to someone else. Here's what the headline noise never admits. Markets can function perfectly fine and still feel completely insane. A system can be working while it's transferring risk from one balance sheet to another. When you understand that, you stop searching for villains and start tracking incentives. Who is forced to act today? Who can afford to wait? Who benefits if price overshoots? Those questions beat any viral statistic every time. I'll break this down simply. First, what happened and why the impossibility framing is wrong. Second, what real mechanics create these monster moves. Third, what I'm watching next and what you can do. Along the way, I'll challenge the claim that volatility is automatically good. Volatility can signal repricing or instability. The difference is context. Let's start with the sigma obsession. Someone takes a one-day move, compares it to a textbook bell curve, calculates a z-score, and says this should not happen in the lifetime of the universe. That gets clicks. It also tricks your brain into thinking if this is impossible, the market is broken, I should exit. But if reality and the model disagree, which is wrong? Reality wins every time. The bell curve assumes extreme moves are rare and returns are symmetrical. That works for controlled processes. It's terrible for markets under stress. Silver has fat tails, volatility clustering, regime changes. Extreme moves are not as small as the normal model claims. In calm periods, silver behaves normally. Small daily moves, mean reversion, boring volatility. But when silver shifts into repricing mode, it stops acting normal. Distribution changes, volatility changes, and extreme days arrive in packs. So when someone says this is a 10 sigma event, they're using a calm period ruler to measure a storm period. Wrong ruler. This should change how you manage risk. Tail events in silver aren't once in a million years. They're career events. You'll see multiple brutal up and down days if you participate long enough. That's the asset. Stop being shocked by it. Shock is expensive. Preparation is profitable. Why does silver behave like this? Because it sits at a weird crossroads. It's monetary metal and industrial input, heavily traded in derivatives, attracts leverage, trades across global sessions where liquidity changes. Favorite arena for positioning wars. Silver's paper market is huge compared to physical. Most price discovery happens through futures and options. Price is set by contracts, margin, risk management rules. When volatility rises, margin requirements rise. Leveraged participants must post more collateral or reduce exposure. In crowded trades, many are near their limits. They get forced out. Forced selling doesn't care about your thesis or fair value. It only cares about meeting requirements before the broker hits the button. That's how you get the waterfall. One group gets forced to sell, price drops, trigger stops, and margin calls for the next group. Chain reaction builds. Algorithms see momentum and accelerate. Volatility spikes, liquidity thins. Move becomes self-feeding. Then the snapback. Once forced selling exhausts, market realizes price overshot. Shorts take profits, dip buyers step in, hedging reverses. Because liquidity is still thin and volatility high, rebound can be as violent as the drop. That's why you get a day that looks like the world ended, then a day that looks normal. Both can be normal for silver in repricing. If you're finding value in this, hit subscribe. We're building a community at Con Invests focused on understanding what's really happening. Now let's talk about what people were actually reacting to. Not the math, the feeling. The feeling was, if silver can drop like that, it can drop forever. That's the emotional story your nervous system tells you to keep you safe. But markets don't work on feelings. They work on positioning and constraints. Here's a constraint that matters. In silver, the marginal price setter is often not the long-term investor. It's the leverage trader in the derivatives market. That means people who get forced to act can move price more than people who want to act. When you see a massive down day, ask, was this forced selling? Look for fingerprints. Speed, forced selling is fast. Breadth, hits everything linked to the position. Reversal, after the forced wave, rebound can be sharp because marginal seller is gone. Options amplify moves through hedging flows. When traders buy puts for protection, dealers hedge by selling futures as price falls. Adds fuel to decline. On the way up, dealers buy as price rises, accelerating rallies. In high volatility, these flows become dominant. Liquidity changes across the day. Silver trades around the clock, but not with same depth. If a big move starts in a thin window, it gaps through levels that would normally slow it down. I'm going to give you a short list of exact mistakes I see people make during these episodes. Listen like it's a checklist you'll use next time. Mistake 1. They interpret volatility as information about value. It isn't. It's information about stress. Mistake 2. They average down automatically without a plan because it's cheaper. Cheaper is not the same as safe. Mistake 3. They chase the rebound to make it back. Most dangerous emotion in markets. Revenge trading dressed up as investing. Mistake 4. They anchor to a single price level like it's destiny. Markets don't owe you your entry back on your schedule. Mistake 5. They use leverage in a product designed to punish leverage and act shocked when it punishes them. Let me show a typical repricing sequence. Step 1. Thesis builds quietly. Price rises steadily. Step 2. Trade becomes crowded. Leverage creeps in. Volatility picks up. Step 3. Catalyst hits. Price drops sharply. Step 4. Forced selling clears weak hands. Step 5. Market rebounds violently. Step 6. Either consolidates and continues or fails and grinds lower. If you only watch Step 3, you think the world ended. Understand the sequence and you stop being emotionally manipulated. Silver doesn't move alone. When markets price tighter policy, currency strengthens and risk assets wobble. Metals get slapped. Then if growth fears rise or liquidity expectations return, metals bounce hard. These flip quickly, which is why silver whipsaws harder than gold. Silver's identity crisis matters. Is it money or industrial commodity? It's both. Gets pulled by two narratives simultaneously. That tug of war explodes volatility. Here's the counterpoint. Some people act like every drop is a shakeout, and every rebound proves the next leg is inevitable. That's avoiding uncertainty. Sometimes the market is repricing higher and drop is a shakeout. Sometimes drop starts a longer digestion needing months to rebuild. How to avoid fooling yourself. Stop using single indicators as religion. Volatility alone isn't a thesis. Volatility is a condition. Thesis comes from supply, demand, monetary dynamics. Global solar deployment continues expanding. While manufacturers reduce silver per panel, scale effect still matters. Electrification and data infrastructure increase demand for conductive components. Baseline industrial pull doesn't vanish because the chart had a rough week. New mine projects take many years from discovery to production. Large share of silver comes as byproduct, limiting how directly supply responds to price. Slow response is why deficits can persist longer than expected. Don't let one volatility burst erase conviction unless anchors change. Watch for evidence demand is weakening materially or supply ramping materially. Not tweets, evidence. The avoid it because it's volatile take sounds prudent but incomplete. Volatility isn't same as risk if you size correctly and have a horizon. Volatility is motion. Risk is probability of permanent loss relative to your plan. We had huge down moves then sharp rebound. People argue opposite things. One crowd said avoid it. Another said load up. Both miss the useful question. Which regime are we in? In my view, we're in volatility expansion regime. Big swings can continue even if longer-term resolves higher. You need a plan that survives chaos. What should you pay attention to if daily candles are basically psychological torture? I use 5 anchors. Anchor 1, structural balance. Is the market running tight over time? Are deficits persistent? Are inventories trending in a direction that signals stress or relief? Is the world repeatedly consuming more than it produces? Anchor 2, buyer mix. Are we seeing demand driven mostly by momentum traders or by longer-term allocators, industrial users, strategic accumulators? Those groups behave differently. Momentum money runs fast in and out. Strategic money moves slower but stickier. Anchor 3, term structure and financing incentives. When markets are stressed, relationships between spot and future prices can shift, revealing scarcity, carry costs, urgency. Anchor 4, monetary backdrop, not just nominal rates. Real yields, currency strength, liquidity conditions, policy credibility. Metals are sensitive to markets' perception of money. Anchor 5, volatility itself, not as a vibe, but as a regime signal. Volatility clustering tells you whether you're in calm waters or rapids. Silver loves rapids. Ask yourself, did any of these anchors fundamentally change in the last few sessions? No. What changed was positioning and leverage. What changed was how crowded the boat was and how many people got thrown overboard when a wave hit. That's why the "it's impossible" narrative is so damaging. It makes you think the whole system is broken. In reality, the system is doing what systems do under stress. It forces weak structures to collapse. Let me bring this back to you in an actionable way. First, stop treating volatility as a verdict. It's a symptom of disagreement, leverage, and repositioning. Second, decide what game you're playing. Are you trading, investing, hedging? Each has different rules. If you're trading, you can't pretend you're investing when it goes against you. Mixing games is how people blow up. Third, size like an adult. If a 30% move makes you panic, you're oversized. Period. Silver can do that. The market doesn't care whether your nervous system can handle it. Volatility is exactly what you want, only if your thesis requires repricing and you can survive the path. Volatility is not automatically your friend. Volatility is a tool the market uses to transfer wealth from impatient to patient. It punishes leverage, overconfidence, people who can't hold through discomfort. The right framing is volatility is the price of admission. If you can pay it, you participate. If you can't, don't pretend. The most important signal isn't the huge down day or huge up day. It's what happens after the rebound when the market can breathe. If volatility collapses and price stalls, that can signal repricing energy is fading. If volatility stays elevated and price keeps making progress despite pullbacks, that suggests market is still in discovery mode. When you saw the big down move, what did you do? Did you sell, freeze, or buy? And why? Drop that in the comments. Silver has a habit of replaying certain patterns even if exact headlines change. We've seen periods where silver goes quiet for long stretches, then wakes up and moves violently. We've seen episodes where leverage builds, margins tighten, then liquidation event hits. We've seen times when public gets excited, market punishes excitement, then resumes bigger move. The lesson is certain mechanics rhyme. Leverage, liquidity, crowded positioning. That's why I don't get hypnotized by one candle. I look for the plumbing. What could happen next? Scenario 1, market stabilizes, volatility compresses, silver trades in range while macro digests. Range phases can be the market reloading. Scenario 2, volatility remains elevated and you get another liquidation wave. That can happen if leverage rebuilds too quickly or another macro shock hits. Scenario 3, market continues repricing upward with violent pullbacks. Surge, pullback, surge, shakeout, surge. Not comfortable, but common. If you're trying to time exact bottom or top in this market, you're playing a game designed for you to lose. Your edge is not speed. Your edge is patience and positioning. What moves make sense for normal people? 1. Reduce leverage. If you're leveraged in something that can do a monster move against you, you're volunteering for forced selling. 2. Define your horizon. If it's weeks, accept you're trading volatility. If it's years, Stop reacting to weekly drama and focus on whether longer drivers are intact. 3. Pre-decide. Know what would make you change your mind. Not price went down, something structural in your anchors. Those Sigma memes aren't just wrong, they're dangerous. When people say the simulation is breaking, they're outsourcing responsibility. They're saying, I couldn't have planned for this, but you can. Plan for tail risk by sizing and accepting fat tails exist. Think of silver like a crowded highway with sudden weather changes. In clear weather, everyone drives fast and close. Fog rolls in, someone taps brakes, suddenly chain reaction pileup. The crash isn't proof cars stopped working, it's proof spacing was too tight. Crowded positioning is tight spacing. Margin hikes and volatility spikes are fog. Forced selling is pileup. After pileup, road clears, but people who drove too close are gone. Here's the signal that would genuinely worry me. If we see volatility die, price stop making progress, and evidence of tightness ease simultaneously, meaning market feels comfortable again, then I reassess repricing narrative. Comfort is not your friend in repricing story. Pressure is. Right now, we're not seeing comfort. We're seeing pressure, disagreement. That's why moves are violent. Think about your own behavior because market exploits human pattern. Fear after down day, greed after up day, recency bias, overreaction, regret. Are you reacting to price or responding to a plan? If you don't have a plan, the market will hand you one and you won't like it. The story you're being sold is this is impossible, so run, or this is proof, so go all in. Both are emotional. The better story is silver is a fat-tailed regime-switching market where volatility is common during repricing and leverage amplifies moves. Correct response is discipline, not drama. This is Con Invests. The market is not broken. Your expectations were. If you stayed to the end, you're ahead of most people. This is for educational purposes only. I'm not your financial advisor. I don't know your situation, and nothing here is recommendation to buy, sell, or hold anything. Use this to think more clearly, and if you need personalized guidance, talk to a licensed professional.